If you had to pick just one number today, the one that really tells the story of how the consensus is shifting, it has to be from the Russell 2000.
Oh, without a doubt.
It was the clear leader. I mean, it surged $19.02, closing the session up a solid 0.76% at 2531.16.
That's a serious piece of conviction, and that outperformance, that 0.65 percentage point spread against the large caps.
Yeah.
That's the whole message.
Right.
The whole narrative of today's session is really built around that surge. But it happened on a foundation of some extreme contradictions.
Yeah, wild moves in commodities and a labor market picture that was just
Yeah.
confusing.
So our mission for this deep dive is to figure out why, despite all that noise, the market chose to lean so hard into the soft landing, Fed easing is coming narrative.
Okay, let's start there. Let's unpack that small cap signal because 0.76% in the Russell it feels like a declarative statement. What does it really mean when small caps lead that decisively?
It absolutely signals a change in risk positioning. I mean, think about where the index is now.
It's hitting close to its highs.
It's just 0.41% below its 52-week high of 2541.67. So this isn't just a bounce. This is the index knocking on the door.
Meanwhile, the big guys are just kind of treading water.
Exactly. The S&P 500 managed a modest 0.11% gain, and the Dow actually slipped 0.07%. That relative strength is the classic tell. It says investors are getting aggressive about future growth.
So what does this move tell us specifically about interest rate expectations? Because those smaller companies, they're just so much more sensitive to rates.
Precisely. They don't have the cash reserves of the big tech giants.
Right.
They often rely on revolving credit lines, shorter-term loans. I mean, they live and die by the cost of capital. So a decisive move like this, seeing money flow into these domestic growth-oriented businesses, it suggests market participants believe lower borrowing costs are imminent. They're positioning for that Fed easing story.
And we saw that confirmed in the sector action too, right? This wasn't just some random rally. It was a pretty clear rotation.
It was absolutely a structural rotation. I mean, look at the leaders. The sectors that thrive when the economy is accelerating, they led the way.
Communication services was up.
Strong, yeah. It added 0.57%. And then you had industrials right behind it, gaining 0.52%. These are cyclical plays.
And on the flip side, the laggards told the same story.
They did. The classic defensive counter-cyclical plays got sold off. Healthcare fell 0.76%, and materials declined 0.58%. The market was explicitly rotating out of safety and into growth. It validates that whole soft landing trade.
Okay, but here's where it gets, intellectually challenging. Because that powerful risk appetite flew directly in the face of what was, frankly, a bizarre set of labor market data points.
You nailed it. Cognitive dissonance is the only phrase that fits. If you looked at the labor data in isolation, you had two completely different stories being told.
Right. On one hand, you have initial jobless claims, plunging
to an astonishing 191,000. That's the lowest reading in over 3 years. Well below the 220,000 consensus. By itself, that screams resilience, tight labor market.
Strong economy, which should kill the Fed easing bets, but they didn't collapse.
They didn't. And that's because we have to look at the counter evidence that the market seemed to care more about.
Okay.
You have to pair that strong claims number, which a lot of people just dismissed as a Thanksgiving holiday distortion.
Right, the seasonal adjustments can get weird.
They can. So you pair that with the week data from earlier in the week. Wednesday's ADP report showed a 32,000 job decline in private payrolls.
That was the weakest print we've seen since 2022.
And then you layer in the Challenger report on corporate layoffs.
And that's the one that paints the really deteriorating long-term picture.
Correct. The Challenger report noted November layoffs totaled 71,321. But the year-to-date cuts, the total is staggering. 1.17 million job cuts in 2025.
And that's up 54% year over year.
Right. So that paints a picture of corporate belts tightening aggressively. It suggests a fundamental shift that's way more structural than the weekly claims data.
So the big insight here is that the market chose to prioritize the weak, forward-looking data, the ADP numbers, the layoff announcements, over the noisy, backward-looking claims number.
That is exactly it. They're dismissing the strong claims number as noise and clinging to the corporate cost-cutting signals. And this interpretation lets them keep the probability of a rate cut high.
How high are we talking?
The likelihood of a 25 basis point cut for the December 9th and 10th meeting, it held steady at around 87 to 89%. The market is basically saying, we hear the noise, but we're sticking to our rate cut trade.
That's a critical distinction. Now, if the labor market was defined by that internal contradiction, the commodity complex was just fireworks, absolute fireworks.
That's a great way to put it. We saw one of the widest single-day commodity divergences of the year. It just proves that not all markets are trading off the same macro script.
Right, let's start with the explosion. Natural gas. It surged a stunning 11.52% today.
Hitting $5.07. That's a 3-year high.
What drove
This was purely fundamental. Two main forces hitting at once. First, cold weather forecasts for key regions, which drives up heating demand.
Sure.
And second, just robust export demand. We saw record LNG exports. November exports were up 40% year over year. That's a massive combination.
But the contrast is what's so fascinating. While nat gas was soaring, another big commodity was just collapsing.
That would be coffee.
Yeah.
It plunged a massive 11.25% to $361.60.
Wow.
And unlike the weather-driven gas surge, this coffee collapse was almost entirely policy-driven. The sell-off came right after the removal of the remaining 40% Brazilian agricultural tariff. That policy shift just eliminated a huge premium that was built into the price.
And I'm guessing that happened to coincide with some good weather news, too.
It did. Favorable rainfall forecasts in Brazil's growing regions. So it's a perfect example of a market reacting violently to a sudden regulatory change, totally decoupled from everything else.
And then there's base metals, which felt like a completely different story from both of those. Copper surged 7.98% to 536. For a base metal, that is a huge one-day move.
It signals something structural, not cyclical. Copper is often seen as Dr. Copper, a bellwether for global health.
Right.
But this move wasn't about sudden demand optimism. It was driven by a supply deficit. The analysis points out that refined copper use is up 5.5%, which is healthy, but mining production only increased 2.2%.
So there's a growing structural deficit.
That's what drove the advance. The takeaway is that specific fundamentals, weather, tariffs, deficits, are overriding everything else in commodities right now.
Okay, let's pivot to fixed income. Because despite all this risk appetite in stocks, the Treasury market sent a mildly conflicting signal.
It did. It's that dynamic you often see when money flows this fast. Despite the aggressive rate cut expectations and the risk-on mood, Treasury yields actually rose today.
The 10-year yield climbed 5 basis points to 4.110%.
Right, it's that sell bonds, buy stocks trade. The longer-term treasuries are suffering, maybe not because the Fed is suddenly hawkish, but because of things like term premium repricing. Investors are just demanding more compensation to hold that long-term debt.
And the nuance in the credit market is really important here for gauging risk, isn't it? The difference between high-quality debt and the riskier stuff.
Absolutely. We look at two ETS as proxies here, LQD for investment grade and HYG for high yield, or junk bonds. Investment grade, LQD, underperformed treasuries. It declined 0.18%. It's duration sensitive, so it reacted badly to the yield spike.
But high-yield HYG, that showed resilience.
Exactly. High yield ticked up 0.07%. This is a crucial sign. It means investors are confident enough in the economy in that soft landing scenario that they're willing to ignore the duration risk to chase that higher yield.
So lower-rated credit outperforming higher-rated. That's a clear risk-on signal within fixed income itself.
Unambiguous. It confirms the equity sentiment even as the broader bond market struggled a bit.
Okay, let's look across the pond at currencies. We had some pretty significant central bank divergence, specifically with the Bank of Japan.
We did. The USD-JPY pair dropped 0.44% to 155.12. And this is a very specific policy-driven event.
What happened?
BOJ Governor Ueda gave his clearest signal yet that they're about to shift away from negative rates. He noted that Japan's real interest rates were, and I'm quoting here, deeply negative.
Which is code for we have to act.
It's absolute code for inflation is running hot and we have to normalize. That statement just fueled bets that the BOJ will hike this month. And that pushed the yen stronger against the dollar pretty rapidly.
And just to complete the picture, we saw GBP/USD also surge.
Yep, up 0.83% to 13300. That followed some upward revisions to the UK services PMI. Again, it's local specific data overriding the broader dollar trend.
Right. which shows just how complex the currency markets are right now.
Exactly. Policy expectations and local data are overriding the big macro factors.
Okay, so shifting back to market health. When small caps are surging and risk appetite is high, you expect volatility to get crushed. The VIX certainly obliged.
It did. It fell 1.87% to 15.78. And that compression of volatility is a significant message in itself.
How so?
The VIX now trades 14.64% below its 50-day moving average. That signals that market participants are positioning for extreme calm and stability into year-end. They're fully trusting this soft landing narrative.
But we know that suppressed volatility can be, well, a dangerous thing. It's the classic calm before the storm.
It is the ultimate double-edged sword. While it reflects confidence today, it creates fragility. If a major catalyst emerges that contradicts the consensus, and we have two massive ones coming up, that compressed volatility can translate into a sharp, painful reversal.
Right. And before we get to those catalysts, let's touch on two big equity movers today that show how much company-specific news still matters.
Absolutely. The market is still capable of huge binary reactions to company news. I mean, look at Meta Platforms.
They surged over 3% today.
And it wasn't about ad revenue or Facebook. It was all about capital allocation. The rally followed reports that Mark Zuckerberg plans to cut up to 30% of the Reality Labs Metaverse division's budget.
And that was so powerful because it addressed that huge investor concern, right? That they were just throwing money into a black hole.
That's it, exactly. The Reality Labs losses have exceeded $70 billion since late 2020. So this news provided a huge immediate relief rally. It's a textbook example of stock price responding positively to investor-friendly discipline.
And then on the complete opposite end of the spectrum, you have Snowflake.
Yeah, a high-growth stock that was severely punished even though it actually beat earnings estimates.
It plunged approximately 11%.
And this is the painful reality for those high-growth stocks. It's all about execution. They met current estimates, but the issue was their Q4 guidance. It implied growth was decelerating down to 23 to 27%.
Which for a company priced for hypergrowth is a killer.
It is. Any whiff of deceleration is met with extreme punishment. It shows the penalty for slowing down.
So we're left with this fragile consensus, a risk on rotation, confirmation and credit, but conflicting labor data and high volatility risk lurking just beneath the surface.
Right. And now we have to look ahead at the two major events that are going to either validate this whole thing or, well, destroy it.
The two bookends for the next couple of weeks.
The first is the December 9th and 10th FOMC meeting. As we said, the market is pricing in an 87 to 89% probability of a cut. The decision itself is critical, but the guidance, their economic projections, their dot plot for 2026, that's what will really matter.
And the second event, which gets at that bizarre labor data, is the delayed employment report.
That's right. Because of the government shutdown, the November report is now scheduled for December 16th. That will finally give us the comprehensive clarity we need on hiring and unemployment.
And technically speaking, the S&P 500 is right at a major psychological level.
It is. The critical resistance is its 52-week high of 69.2034. The market is only 0.91% away from that. A decisive break above that would be a major validation of this whole rally.
But failure there could trigger some serious profit-taking.
For sure.
So if we zoom out, there are really three clear scenarios the market is wrestling with, depending on how these catalysts play out.
Yeah, and this gives you a framework for watching the news. Scenario 1, the base case the market is priced for, is soft landing confirmation. The Fed cuts, payrolls are moderate, the S&P breaks its highs. That's the dream scenario.
Okay, what about the tricky middle ground?
That's scenario 2, the hawkish cut. This is where the Fed cuts by 25 basis points, but then uses its guidance to signal way fewer cuts in 2026 than the market expects.
And that would cause yields to spike.
Yields spike, growth stocks suffer, and the dollar strengthens. That would completely destroy the Russell 2000 rally we saw today.
And finally, the most painful one, the scenario that the low VIX is ignoring.
That's the data shock scenario. The delayed jobs report on December 16th shows significant, undeniable deterioration. If that happens, markets rapidly reprice from soft landing to immediate recession concern.
And the VIX would.
The VIX spikes violently above 20, confirming that fear is back. That high volatility risk is the true threat hanging over everything right now.
That is a fantastic way to frame the risk and reward here. We covered a really mixed day-strong rotation, wild divergence, but it's all pointing toward this very fragile consensus that's about to run headfirst into some critical data.
Indeed. It's going to be an interesting ride into year-end.
All right, I think that brings us to the end of today's deep dive into the market action. That's the daily consolidation for today.
As always, remember this is all purely for educational and informational purposes. We're here to analyze, not to give financial advice, so please always do your own research.
And if you found this helpful and want to stay on top of these market narratives, just take a moment to subscribe. We are back every trading day, right after the closing bell.
See you next time.